Hello, my name is Christina Roman, and I'm the Consumer Education and Advocacy Manager at Experian. Welcome to a special episode of Credit Chat Live. Today, we are joined by Rod Griffin, Senior Director of Consumer Education and Advocacy at Experian. Now, in our previous episodes of Credit Chat Live, we've featured a special guest, but we wanted to come back together to create this special episode addressing credit myths, because no matter how many times we discuss these credit myths, they seem to just be everywhere. They're pervasive. Rod, you've been doing credit education for 25 plus years, and it seems like the same myths that you addressed when you first created some of our decks are the same myths that we're talking about today.
No doubt about it. When I started, I didn't have any of this gray hair stuff. That we were still talking about things about credit scores and collection accounts and who gets to see them and who doesn't and how does that all work and can I check my own credit report, and all of those things still seem to cycle up. It's one of those, things where they kind of, some of them will go away for a while and then they bubble back to the surface. Sometimes they have a little different twist, but it's the same kind of misinformation and seriously harmful information in a lot of cases for people that it keeps them from making better credit decisions, better financial decisions.
Absolutely. I remember, I'll never forget, I was sitting in a barber shop with Josh, and he was getting his haircut, and I was just waiting for him. And the barbers were talking about credit. And so one of them was talking about how he was wanting to improve his credit score, but he needed to check his credit score. And another barber said, "No, don't check your credit score. Don't you know that that hurts your score?" And then everybody was really surprised about that. And I was sitting there like, no, please check your credit report. Check your credit score. It's not going to harm your credit score at all. So this is a common myth that we hear where people don't want to look at their credit report or their credit score because they think it's going to impact them negatively, when in fact they should be checking it.
Absolutely. And, that's kind of issue number one. People are afraid to check their credit report for lots of reasons. They're afraid of what they're going to see. They're afraid that they won't be able to do anything about it. But you should not be afraid to check your own credit report because you're worried about your credit scores, because it does not affect your credit scores. If you get your credit report through annualcreditreport.com, which is the federal portal to request your report from each of the three credit bureaus, which, by the way, you can do 156 times a year now. You can get a free credit report from each bureau 3 times or once a week. So 3 credit reports a week, essentially. Doesn't affect your credit report. It doesn't affect your credit scores. You would see potentially an inquiry that shows you've gotten your own report, but lenders aren't going to see that. It's not going to affect credit scores. So don't be afraid to get your own credit report. Same thing's true if you're enrolling in a monitoring service. If you enroll in an Experian monitoring service, for example, you can check your own credit report as often as you like in your credit scores. It's not going to hurt your scores at all. And it's going to give you the tools and information you need to actually make them better. And that's what's really important.
Absolutely. And, going back to what you mentioned about annual credit report, I remember when I first started at Experian and we were doing social media education on credit, and we would tell people you could access your credit report for free every 12 months from each of the credit bureaus. So we would tell people space it out a little bit so that way you can check your credit report throughout the year for free. So this was something that we started during COVID, where consumers could access their credit report for free weekly. And then that was just something that we decided to continue to make available to consumers because we believe it's important for you to be able to access your credit report and to know what information is being reported about you by your lenders. I also love that you mentioned that. Oh, sorry, go ahead.
Well, I was going to say, and it's industry wide, so not just Experian. We, as an industry, the 3 national, the companies that are known as the 3 largest credit bureaus in the country, all agreed, and so we all are providing a report once a week for free, and it's permanent now. So that's not going to go away.
Yes. Now, one thing to note, if you wanted to get your credit score, that is not included in annualcreditreport.com when you're accessing your credit reports for free. So you're likely going to have to opt in for a paid credit score through that service. But as Rod mentioned, Experian offers your Experian credit report and your FICO score for free through our free credit monitoring service.
Yep.
Let's get into myth number 2.
Okay.
Carrying a balance on your credit card improves your credit score. Now, this is something I was just asked in another podcast about. How can we talk about how much credit should somebody realistically carry on their credit card to have the best possible credit score?
Yeah, and it's been going around a long time, and it comes up in different ways. But it's always positioned as sometimes it's you have to carry a balance in order to improve your credit scores, or you should only pay off 95% of your balance each month to improve your credit scores. None of that's true. If you don't pay off the balance in full, the only thing that does is cost you money because you're going to have to pay interest on that balance. From a credit scoring perspective, ideally pay the balance in full each month. That's going to be the best thing you can do. Credit scores, you and I talk about this all the time. The second most important factor is your utilization rate, your balance to limit ratio on your credit cards. If you're carrying a balance, it's going to have a negative effect on your credit scores, and the higher that balance is, the more negative the effect will be. So if you can pay the balance in full, that's best. The other thing I get asked a lot, and I know you hear this too, is, well, should there be a balance showing on my report? Well, the balance on your credit report is typically the balance on your billing statement. So if you get the billing statement and then you pay it in full, you're still going to see a balance on your credit report, even if you pay it in full. So you don't have to worry about that. Really, the only way to have a zero balance showing in your credit report for your credit card is to pay it off completely and then not use it at all for at least a month. And then you might see a zero balance. And then the next month, actually 2 months, because in the next month they'd have a zero balance reported. So but you don't want to do that either, because then you won't have any activity, and you need activity in the account for it to be included in scores too, which dives us into the kind of things people don't really understand. But we could chase down that rabbit hole, or we could keep talking about this myth, the way it keeps rolling up.
Yeah.
Back all the time in some different form, it seems like.
I know there are some people that truly treat credit as a game, that they want to game the system. They want to use their credit, and then they keep track of their statement closing date. So they try to pay their balance before the statement closing date. So they use credit, pay that balance before the statement closing date. So that way the amount is not reported to the credit bureaus because the statement has closed, and then they report that amount that's left on the card after that. But I just think that overcomplicates the system, trying to keep track of so many dates rather than just making sure that you make your payments on time every single month. If you're going to pay that balance off in full either way, what's the difference waiting one more month to see that balance reflected on the credit report, or 2 more months to see that balance reflected on the credit report, unless you're trying to make a major purchase and you don't want that balance to be reflected.
Yeah, I mean, and it's common sense stuff generally. Make sure you pay the bill on time, which means by the due date, and you'll be fine. Another myth that comes up is, if I make more than one payment a month, it will help my credit scores. Not really. It's not that you make 2 or 3 payments in the month isn't going to help. It's, did you make at least the minimum payment due by the due date? So whether you do that with 1 payment or you do it with 3 or 4 isn't going to affect the credit report. It might help you manage your payments better. That's kind of up to you, but it's not going to affect credit scores by making more than 1 payment a month, just in that sense. Now, if you reduce the balances over time or throughout the month, maybe. And you also did another good point. We talk about one card. Most people have more than one credit card. And so then if you start trying to track when are the closing dates for the payment cycle each month for each of those cards, and did you get them mixed up, or are you ahead of them, or when do you need to do it? And it really can get complicated and confusing, and you probably don't know exactly when the closing date is anyway. And your credit report's updated by those lenders. Your credit cards will be reported at the same times each month, but that doesn't mean if you have 2 cards, one might be updated at the beginning of the month, one might be updated at the end of the month. So it's a constant cycle, and I'm not smart enough to do that. I get way too confused, way too easy. I just make sure I pay my bill on time every month, pay it off in full. And that can be easier said than done. But the lower the balance, the better. That's really the key.
Definitely. And you mentioned minimum payments, and I kind of want to just, excuse me. Yeah, I'm sorry. I don't know what that was. Dustin, you can cut that. I mean, rephrase that. You mentioned minimum payments, and I think that's a really important aspect of paying off your credit cards that we should touch on, because some people ask, well, isn't it okay that I only made or that I at least made my minimum payments on my credit cards each month? And it's important to note that if you're making your minimum payments on your credit cards while you're meeting the requirements for having paid on time by your creditor, you're only paying off a very small fraction of your interest. It's going to take you so long to pay a credit card balance off if you're only making your minimum payments. And one thing that I like to recommend that people do is to look at their credit card bills, and you'll see in there, if you pay your minimum payment and only your minimum payment, it'll tell you how long it's going to take you to pay that card down at the current balance that you have it at, and how much you're going to pay over time. And it's really an eye-opening exercise to do.
Yeah, that's something they call the Schumer box is on your billing statement. It's a matter of law, and it has to lay out your interest rates and which it's going to cost you to repay that, what your debt, how long it will take to repay a debt. All of that is in as a matter of law. And Senator Schumer, I think, was the primary sponsor of that requirement. And you're right. And the other issue that you don't think about is that's if you make the minimum payment and don't make any other charges.
Mm-hmm.
You are making the minimum payment due, and then you add to that balance. Now you're making the minimum on a higher balance. It's going to even take longer to pay it off. And the way to think about it from a credit scoring perspective or credit reporting perspective is that minimum payment is the minimum you have to do to be current and paid on time in your credit report. So, you need to do more than the minimum payment if you're going to reduce your debts, and it's going to help reduce your utilization rate. It's going to help you improve your scores faster, for sure.
Definitely. And that was a mistake that I made in my 20s, was I didn't realize I was making my payment every month, and I was like, why is it not going down? I'm making my payment. And then I actually ended up calculating how much I had paid over the amount. I think I did it for a year, only the minimum payment. And if I had kept going, I was going to pay double what I owed in that credit card. And that was just because I didn't really understand how to pay it back. I just thought, okay, this is the amount I owe, great, and then I'll pay it off eventually. But it's really important to sit down and take the time to identify, okay, how much do you owe, and make a plan for that. One thing I recommend from when I was going through the credit debt payoff process was a credit card interest calculator, because that helped you to figure out, okay, this is how much I owe, this is the interest that I owe, and then you could say I want to pay it off in 10 months, or I want to pay it off within a year, and it'll tell you how much you need to pay each month. Again, that's ensuring that's only works if you're not going to charge any more on that card, which I always recommend to do if you're in a debt payoff process. Don't use that card until you get that card paid down.
Yep. And it's a matter of discipline and the budget we always talk about. I have a friend who's a college professor, and she doesn't like the word budget, so she calls it a spending plan. I'm okay with that if it makes you feel better. It's still the same thing.
Yeah.
But it's, you have to have a plan, and then you have to keep those balances as low as possible. Again, another myth that kind of comes to mind is the 30% myth. Credit scores, you'll hear that you should never have, your balances should not exceed 30% of the credit limit. That's true, but it's often presented in a way as if that's the goal or a target or where you should try to have your balances. And that's not true. That's the myth. That 30% number is actually a maximum. It's something you should stay as far below as possible. What happens is, what the credit scoring companies have found is that if a person's balances on their credit cards reach 30% of their credit limit, the risk of default or not paying that debt begins to accelerate faster. And so your scores will drop faster. You're carrying any balance, you might see an effect on your scores, but when you hit that 30% utilization, instead of scores kind of having a slow, slight kind of decline, when you hit 30%, they just kind of fall off the map because the risk of you not paying it back then skyrockets. So
Yeah.
The analogy I use is kind of like buying a diamond. When you buy a diamond, you find out that when you hit 1 carat size, the price goes up because they're that much more scarce.
Yeah.
If you get a diamond that's like 0.99 carats, I found this out a long time ago when I got married. So it looks just like a carrot, but it doesn't cost nearly as much. Not that it's
Oh, wow.
so you can save significantly, um,
Yeah.
and still get a really nice diamond. So and then you can tell everybody it's a carrot because it's so close, no one would ever know.
Rounding up at that point.
Yeah, rounding up, say, hey, 1,000 for the carrot or whatever. But but it's the same kind of thing. It's a scarcity thing, and with scores, it's that increased risk according to all the research they've done. So pay it in full if you can. That's the biggie.
Yes. And talking about debt, what about if somebody has a missed payment that's been reported to their credit bureaus, and then they work hard, they get caught up, and they check their credit report in the next couple months, and they're upset to discover that the derogatory mark is still on their credit report, even though they're all caught up and paid in full. This is a common myth that we hear, that people say, well, I paid it. Why is it still negatively impacting me?
Yeah, and the thing to remember is that your credit report is a credit history, and that late payment's going to stay for 7 years from the date of the missed payment. And when we talk about missed payments, that's another kind of common misunderstanding. Is a missed payment from the credit card company or the bank's perspective is different than what a missed payment is for the credit bureaus. A missed payment for the bank is the day after the due date, or maybe later in the day of the due date. For a credit bureau, a missed payment has to be a full billing cycle late, so a full 30 days. So if your due date is today and you don't make that payment on time, but you catch up tomorrow, it will never show up in your credit report. You have to miss the payment today, and then the same date next month when it's due again, still have not paid that payment, then it's reported as a 30-day late payment to Experian. So it's 30 days late, 60 days, 90 days late. That's why you see it that way in a credit report. But 7 years from the date of that missed payment, that late payment will fall off. The further in the past that occurred and you brought everything current and it's on time, the less effect it will have on credit scores. And so people don't realize that too. It's the further in the past something negative happened, the less effect it has on credit scores. So if you can catch up and keep paying on time, it's going to help. Eventually it will come off.
Yes. And I have to confess, I got caught slipping a little bit, Rod, because I paid a credit card off, and I forgot that I had one automatic bill that charges to it each month. And so I hadn't looked at it, and I received an alert from my credit card company, and I was like, oh, I don't know anything on that card. And then they sent me a mail notice saying, hey, make this credit card payment because you're 15 days late or something like that. And then I logged in and I was like, oh my gosh, I completely forgot that this charge. And it was just a subscription, I think, to Microsoft that was still charging on that card. And if I had gone and I had gotten reported for a $6.99 fee, I would have been so upset. But it is important to note that your creditor will likely try to contact you a couple of times to remind you that you're late on your payment. So that way it gives you that chance to get caught up. So make sure you're checking your emails regularly, your mail regularly, because that can help you in the event that you have one of those brain slips where you don't realize, oh my gosh, I forgot that this charge still goes to this card.
Yeah, your creditors do want to get paid, and they usually don't remind
Yes.
you of that. They're not shy about that. So, and it happens, it's sometimes life happens. And if you've never had a late payment, if there's nothing in your credit report except that one late payment, you talk to your creditor, your lender, and ask them if they can help with that. Often, if you've never had any other late payments, so life has just happened once, they'll remove the late payment and waive fees and things. So don't be afraid to talk to your lender either. If it's a recurring issue, probably not. But if it's just once every in a lifetime thing, they'll probably work with you. Or once it's a rare occasion, that they're often willing to work with you.
Yes. And so Rod mentioned that late payment that's been reported to the credit bureaus will remain on your credit report for 7 years. I also want to alert you to some other time frames that information stays on your credit report. So open accounts in good standing will remain on your credit report indefinitely. Closed accounts in good standing will remain on your credit report for 10 years. So that goes back to that credit history. Later missed payments, we mentioned 7 years. Collection accounts, 7 years. Bankruptcy, Chapter 7 bankruptcy will remain on your credit report for 10 years. Chapter 13 bankruptcy will remain on your credit report for 7 years. And that's just because you've paid a fraction of your debts, what you owed back. And then credit inquiries will remain on your credit report for 2 years. But I want to go back to that collections one, because that's another one that we hear. Hey, I paid my collection. Why is it still showing up on my credit report? Can we talk about that a little bit?
Yeah, sure. And there are two things really that are important. The 7-year time frame for a collection is different than for the original account. So if you miss that payment, it's 7 years from the date of the missed payment. With a collection account, it's a little more confusing because that 7 years starts from the date of the first missed payment in the original account, after which you were never again current. So it's the late payment that led to the charge off and then the collection. So we call it the original delinquency date, or date of original delinquency. So if your due date's today, you missed the payment and you never catch up on the original account, it's charged off as a loss and then sold to collection. It's 7 years from roughly today from that first due date that it would fall off. So it's treated as a continuation of the original debt. And so the original debt and the collection will come off at the same time. So that's often something people don't understand. So if you make a payment on that collection account, it does not reset the clock. The law requires they report that original delinquency date. You can talk to the collection agency, you can work with them, can negotiate with them. It will still fall off at that 7 years from the original delinquency date. So there's a lot of myths around that part of a collection account too. Is you don't talk to them because and it's you can, because the law it's not going to reset the clock. It's here. So that's the first thing. On the flip side, if you do pay off a collection account, it's still a credit history, and it's in most cases it will still be there, still show in the credit report until the end of that 7 year from the original delinquency date time frame. So it'll still be there. But with the way scoring systems work today, the newest ones, especially from FICO and VantageScore, if you pay off a collection account, they will ignore it once it's reported as paid in the credit report, essentially. So it's excluded from the score. So even though it's still part of the credit report, paying off a collection could cause your scores to go up almost right away, or at least as soon as that payment's reported.
That's very beneficial to know for the people that are nervous about answering that collector's call because they don't want to reset the clock, or they have that fear that that's going to reset the clock. It actually kind of incentivizes, no, answer the call, see if there's a way that you could pay that collection back. So that way it stops interfering or impacting your credit score, because then the newer algorithms won't recognize it. So that's really important to know. Now, when it comes to medical collections, because a lot of people have questions about regular, their debt collections and then their medical debt collections. Anything that they should know about that?
Yeah, so a medical debt does not appear in a credit report until it's been reported as a collection. We don't report that collection until it's been in collections for at least a year, for 12 months. So that gives time to make sure it's not the result of like a billing error or an insurance dispute, those sorts of things, that it's legitimately a debt that's owed. We've also removed any medical collections that are less than $500. So it's, we actually over the last 2 or 3 years, we've removed something like 70% or more of medical collections from credit reports. So they're becoming less and less common. When you do pay that medical collection, we remove it from the credit report. So unlike other collections, it will come clear off of the report. So it wouldn't be there at all. And just kind of speculation, I think we probably will have medical collections removed from credit reports, probably by law within the next few years. Some states are already passing laws that are requiring removal of all medical collections. The CFPB has a proposal to do that too. So, we're not sure exactly what's going to happen, but the majority of medical collections have been removed from reports. The ones that are left are more than $500 are fairly significant. So,
yeah. And when it comes to medical debt, it's so interesting because Josh, he went to the hospital at the end of last year and was in it for a couple of days at the beginning of the year. And we were getting so many different bills because he had to see so many different specialists that I was trying to keep track of everything. But sometimes I wouldn't receive a bill for a doctor he had seen in January until May or June. And so it is important. It is actually kind of nice that you have that time frame of a year to before it shows up in your credit report if it's been reported to collections, because sometimes it's hard to manage and figure out who do I owe, how many doctors did he see, and really keep track of those. And I had a good system in place where I was tracking bills, but sometimes it can just be downright confusing when it comes to the medical billing process. So that is helpful.
Yeah, it happened to me too. I mean, actually with a dentist, and I had a something done, and they had a issue with the insurance payment, and I got a notice saying that my payment was 90 days past due, and I didn't know I had a payment due.
Mm-hmm.
Immediately called and went, well, and they got it resolved, and so there was no issue with my credit history. I didn't have to worry about that. Fortunately, I knew that when I saw it. Like, okay, I'm not worried about my credit report, but who hasn't paid my bill that it's supposed to? Because when it was handled, I was a little perturbed about that part.
Yeah.
But it wasn't, didn't have to worry about my credit report because I knew that wasn't going to be an issue.
Yes, absolutely. So I'm glad that we busted those myths. I have two more myths that I would like to cover because this one was actually an interesting one from a presentation I recently did, where I had asked a true or false question of your employer can get access your credit score. A potential employer. I'm sorry, let me rephrase that. A potential employer could access your credit score during the hiring process with your permission. True or false? And everybody selected true. And they were surprised to find out that that is actually false. So that is a myth that I would like to discuss because it seems to be a very common myth that a potential employer could access your credit score.
It's a huge myth, maybe the worst one in the mythology around credit scores. And since you work for me, and I've told people, if I ever hear you say that a credit score will keep you from getting a job, I'll fire you on the record. Because it is absolutely not true. Employers do not get credit scores. They get a credit report with your permission, and you have to give written permission, and it's a limited credit report. But we do not provide scores with the credit report. So they get an employment insight report is what we call it. And it removes anything that would violate Equal Opportunity Employment Act regulations. It takes things like account numbers out. Employers don't need them. So they get identifying information, you know who you are. It's one of the reasons employers use a credit report is to verify your identity and to make sure you are who you say you are. So they'll match that identity to your application or to your resume, that kind of thing. Make sure that you are who they're hiring and prevent employment fraud. And then account information, so your payment history, those sorts of things. No credit scores. And typically when we see credit reports used in hiring decisions, it's for one of two reasons. It's the employment fraud issue. So they want to make sure you are who you say you are.
Mm-hmm.
The other is that they're hiring for a job that's going to involve managing a company's money in some way. So it kind of makes sense. They're looking at, if you're going to be an accountant, probably should be managing your own finances well if you're going to manage the company's money. So that's typically what we see them looking at.
Yes. And I think this kind of ties in our next myth that we wanted to bust pretty seamlessly because a lot of people think you don't need to worry about your credit report or your credit score if you're not going to apply for a loan soon. And this is absolutely false because your credit can impact so many different aspects of your life, including, as we just mentioned, a potential hiring process. It could be a part of a potential hiring process. Now, there are some states that state that credit report cannot impact a hiring decision. So correct me if I'm wrong in that, but I believe that is the case. So there are some states that say that credit report cannot be a factor in the hiring decision. However, it could be a part of that hiring process. So what other aspects of our everyday life can our credit history, our credit score impact?
Yeah, we don't think about all of the financial relationships we have. We all carry a phone now, a smartphone, and at least almost. You don't realize it when you're applying to get that new phone that they're going to look at your credit report, and they have scores that they use to determine whether you'll pay your phone bill on time. So getting a phone, renting an apartment, so leasing agencies, leasing companies can check your credit report. Setting up utility service, they may check your credit report. Um, just about everything. Getting insurance, so having auto insurance, they're going to check your credit report, and they have their own insurance scores, which are different than what lenders use. And they're not predicting that you'll have a wreck. That's another myth I hear sometimes. It's what they're looking at when you're getting insurance is, will you be able to pay the premium on time? It's very much like credit. It's a payment once a month for most people. And will you be able to make that payment on time, or will you make a financial claim? So that's what they're looking at with their own kind of scoring systems in the credit report. So it's pretty ubiquitous. It's a lot more than just applying for credit. And so, checking that credit report is really important. Checking your credit report could indicate that you're a victim of fraud, so you can act on it. People don't think about that. So check your credit report. Or, if you get a notice of a security breach and they offer a free monitoring service, take advantage of that. Make sure that you're getting your credit history monitored so that you can find out if you're a victim of fraud. Enroll in a free monitoring service like Experian, and we'll notify you of any changes in the report. So it's really a financial tool that you should be using, just like a billing statement that you get every month. So you know what's being reported about how you're paying your debts, and what's in that report, to make sure that there's no indication of fraud or identity theft, to make sure that it's where you want it to be, just in case you need to use credit. And I think that's another thing that people don't think about. I'm not planning to apply, like you said, so I'm not worried about it. But things happen, and you might
Mm-hmm.
find that you do need to. And so you'll want it to be there to work for you, and you'll make sure that it's in good shape, so that in case you do need that credit history, it can help give you, the kind of protection and additional access to financial services that you might not otherwise have. So, really important to take care of it.
Yes. And one of the things I love about credit monitoring is that when you check your credit score, it comes with a list of factors that are benefiting your credit score, they're hurting your credit score. So you have a pretty good understanding of what behaviors are impacting you positively or impacting you negatively. And you can kind of create a plan of action for what you're going to do. So, okay, do you have too much debt on your credit card? So is it saying your utilization is high? You need to work on paying that down. So it gives you actionable steps that are specific to the information that's in your credit report. And I love that, because we get asked often, well, what do I do? How do I improve my credit? Access that credit monitoring service, because it's going to tell you exactly what to do. We can give you generic tips: make your payments on time, keep that utilization low. That's going to help you over time. But what factors are specific to you, that's where a credit monitoring service can really be handy.
Yeah.
And Experian offers it for free monthly, so take advantage of that.
Yeah. I mean, there are 220 million people, actually more than 220 million people with credit reports. And they're all unique. They're all a bit different depending on how a person's using their finances, what they have in terms of credit, how they use it. And so, it's impossible to say do this and you'll have a great source. Other than, like you said, you have to pay your bills on time every time. You have to keep your credit card balances low. Everything else sort of built on that. But a couple of other myths. Another myth I often hear is that you have 3 credit scores. You don't. You have 3 credit reports. You have 3 national credit reporting companies: Experian, TransUnion, Equifax. So you have 3 credit reports. There are actually hundreds of different credit scores, and so they can all be different. I mean, I've seen scores with scales that are, they go from 75 to 108. That was a credit union score. There used to be a score called the National Risk Model that went from 1,300 to 0. The lower the score, the better. We're familiar with the 350 to 850 kind of scale with FICO and their standard scores, and Vantage score as well. But there's also a FICO score for car lending, auto lending, that goes to 900. So you could have a score above 850. And so there are different scores for different types of lenders: credit unions, national banks, credit card companies, insurance companies, and different types of lending. So buying a car, getting a house, getting a credit card use different scores, because they're using the information from a credit report to help them predict how you'll repay them for that particular kind of service. And so the scores use the same information from the credit reporting companies, but they weigh it a little differently depending on what they're trying to do. And so it's important to understand there are lots of different scales, so you can have lots of different numbers. So, I always tell people, don't try to compare number to number, but what you just talked about with the risk factors is key.
Mm-hmm.
When you get a score, if you get the risk factors that go with it, so exactly what from your credit report most affected the score, will tell you what you need to work on. Numbers can be very different. The risk factors tend to be very consistent from one score to the next. So if you take care of your risk factors in your credit report, all of your scores are going to be good. And I've never seen a person who had a good score with one system and a bad score with another. So
Mm-hmm.
your credit report, you'll have good credit scores.
Yes, absolutely. Now, Rod, I feel like we could talk about credit myths all day, and we could talk about credit facts. I think we could do a whole podcast just on credit score risk factors and the different credit scoring models, and maybe that's something that we have to do in the future. But for now, we've busted 6 awesome credit myths that are pretty pervasive that we've been trying to bust for 20 plus years, and we're still having a hard time doing that. So hopefully by now, this is the last straw. People will stop believing these common credit myths, and we're going to have a couple of more episodes, just you and I talking about fun credit facts, because I had a lot of fun today.
Absolutely. And I hope that's true. That just when you hear something on social media, provide this link, say, listen to this, because you don't want to mess up your credit history. So, or don't believe everything you hear.
Exactly.
And maybe the biggest myth of all is anyone who's telling you there's a quick fix. If you do this, or if you just pay me, it'll be great tomorrow.
Yes.
It doesn't happen. Your credit report's a history, and you can take care of it yourself. One more myth. So I'll add one more that I think is important. I hear people say, well, my credit report's messed up, so I'm giving up because I can never make it better. That's absolutely not true. You can always improve your credit history. It takes time, it takes commitment, it takes effort, but your credit history isn't permanent. You can change it. And so don't ever fall into that myth and that trap. Just know that, things can be tough. We've all been through it. Christina and I have talked about this. We've messed up our credit bad at points in our lives. And so we've all been there. And so there's no judgment from us. It's like, we know exactly what you've done because we've done it ourselves before we started working for Experian, before we understood these things. So,
Yes.
you can change it. And I think that may be one of the biggest myths of all is, that you can't change your credit history, because you can.
Yes, and I think that's why we both do what we do, and we're passionate about what we do, because we know that people just need to hear that they're not alone, and that they can take actions today that can benefit their credit and make real change for them in their financial life. And we have so many resources available to you at Experian. We have a blog that is just dedicated to credit education. It's our Ask Experian blog. Rod and his boss started this blog many years ago, and it's still going today. It's a core part of our website. And so if you have a question about credit, I can guarantee you there's an answer on that blog. We at least have maybe 1, even 5 articles dedicated to that question. So whatever you would like to learn about, visit Experian. We have a wealth of resources. Check out our credit monitoring service. As we mentioned, it's free. You can access your Experian credit report as well as your FICO score. And then join us on Credit Chat on Wednesdays. Each week we cover a different personal finance topic. Right now we host the conversation on X. There's many ways that you can get engaged with us. Rod, do you want to share where people can learn more about you?
Yeah, so again, Credit Chat on Wednesdays. Join us there. 2 o'clock Central, 3 o'clock Eastern. I'm on X at Rod_Griffin. And then around everywhere else, wherever Christina tells me to be on social media, and to reach out to people, and try to answer your questions and make sure you have the knowledge you need, because we, working for Experian, have really a privilege of being exposed to information that you likely wouldn't be. I didn't know what I know until I started working for this company 27 years ago. So it's a long time ago, but it's been I still learn things every day, and things change. Join us, join the conversation, and look for good qualified, experienced people to get answers from, and watch out for that quick fix because it never works.
Yes.
Gets you deeper into trouble in most cases, or it separates you from your hard-earned money. So always a caution I have, but join us and share in the conversation. I think that's the best thing we can do is learn from each other.
Awesome. And I join Rod every week on X. I'm at Tina_LaRoe. So you'll see me chatting about whatever topic we are talking about. And every once in a while, I share additional tweets on whatever, we're doing at Experian. So, and you can also follow me on LinkedIn. I'm at Christina Roman. I hope you've enjoyed today's Credit Myths conversation. Rod and I definitely have several episodes that we can record coming up about some of the topics that we discussed. So I'm making notes of that. I hope you enjoyed the episode. Let us know what you think. Let us know if you're on Facebook or Twitter or even Instagram watching this conversation. What are some myths that you've heard that maybe we can address in a future episode? I hope you have a wonderful day. Thank you for joining us today.